45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Good afternoon, everybody. Thank you all so much for taking some time to join us on a very exciting webinar that we have scheduled for you folks. We're going to be covering the One Big Beautiful Bill Act. This is the new tax bill that has been implemented for 2025. So lots of new changes, lots of things that I think are really important to be made aware of. And we have a great presenter that's going to be able to share some insights and the values and the changes that I think could make a big impact in everybody's tax liabilities and kind of what they're used to here. So before I make those intros, I want to go into a little bit more of Marshall Reddick and who we are, just for those of you that may be new. So without further ado, my name is Vince Tomich. I'm an advisor and realtor here at Marshall Reddick. I've been with the company now for just over 7 years. I function as a realtor and advisor. And basically a lot of what I do is, folks that are new to Marshall Reddick, I learn a lot about what they're looking to do, right? Whether it's purchase real estate, whether it's property management, whether it's private lending. And so often we get a lot of other types of scenarios that come in the door, like 1031 exchange questions and tax questions. So it's really such a benefit to be able to partner with amazing folks like Tony at Robert Hall and Associates, who I'll be introducing shortly, and those other professionals to implement into this world of real estate. But prior to my role here, I spent time as a conventional lender. I like to also mention, I practice what I preach. In addition to, of course, working at the company and encouraging folks and helping folks buy investment property, I also own investment property myself. So it's nice to share kind of that story. Truth be told, too, I work with Tony personally, too, on tax stuff. So it's been always just so amazing to be able to share those contacts and those people that help us out so very much. So for those of you that are unfamiliar with Marshall Reddick, or maybe are not as familiar, I'd like to just kind of explain who we are and what we do. So Marshall Reddick is a full service real estate firm, and we have our brokerage, property management, private lending, and our investment funds. So for our brokerage, we help people buy and sell, whether that's a primary residence or an investment property, right? And 99% of those people who end up buying an investment property are going to need property management. So we handle that from start to finish. So marketing property, rent collection, rent disbursement, any kind of maintenance or repair request, we would handle that on the owner's behalf. In addition to that, we're also a private money lender. So not like your typical conventional lender who's doing, owner occupied or conventional types of purchase. We're going to be helping those borrowers who are doing fix and flip loans or bridge loans, maybe new construction, or even if you have a self-directed retirement account, you may need non-recourse financing. That would be a good example of someone who would borrow from us. And then lastly, we have our investment funds. So the same way that you can invest in property and collect a rent check, we give our investors the opportunity to lend their capital and collect mortgage payments. And we do this actually in 2 ways. You can be a direct lender, which means one borrower, one lender, but you can also invest in our mortgage fund. So that's a pooled investment. It's a debt fund that has, hundreds of loans in it, and that allows us to disperse a quarterly distribution to you folks, and you're able to spread your money and lend across the country, right, in various different loans. So that's a little bit more about some of the opportunities that we as a company can provide from an investment standpoint. And I'd be happy to help share or elaborate on any of those on a one-to-one and to get on a call to discuss further. But that's just a good highlight to better understand. Here's a quick screenshot of all the markets we're in. So I am located in our Newport Beach office in Southern California, but we do operate in Texas, Tennessee, and Florida. And you can see the major cities that we have a presence in. This is boots on the ground services. So these are agents, property management services. These are brick and mortar folks on the ground that can help and offer our services in all of those markets. Now, some of the topics or questions that we're going to be covering tonight are, what are the main changes in the 2025 tax code? That's really important. Since a lot of you are coming from the Marshall Reddick platform and real estate, we want to know what are the most beneficial components of this tax bill for real estate investors. How can I position myself personally to take advantage of the new code? So going over all of these things, what do you need to be doing or implementing to take advantage? That's something that we're going to cover. And then who can I speak with to determine how these changes will impact my own tax return? So that kind of leads me to my next slide. And without further ado, I want to introduce Tony Watson. Tony has been an amazing resource for me personally. As I mentioned, I work with him as well as so many of our clients. Robert Hall has been an amazing partner, an absolute wealth of knowledge, has taught me tons and tons of stuff. So I always really enjoy these presentations with Tony. And take it away, Tony.
Hey, thank you so much. I mean, I've known the team at Marshall Reddick for so many years. I feel like the pandemic really messed up all of our in-person meetings and the ability to drive down and do some in-person events, but thank goodness for the digital world connecting us all through this this wonderful platform. And so hello everyone. If you've heard me speak before, you're very aware of what I do. I'm the tax guy. I'm a real estate investor myself. I'm a small business owner. So everything that I speak on in my webinars from a tax perspective, it's pretty much like copy and pasting the advice that I take into account on my own tax returns. I service a clientele roster of roughly $500 million in managed real estate and other business dealings. I have about 20 years of experience with Robert Hall & Associates, speaking throughout the year at over 140 events on an annual basis on average. In fact, tomorrow I'll be in downtown Los Angeles at the Builders Expo at the convention center. So if you're in the downtown area, feel free to stop by. It's going to be a big event. I am not only the public speaker for Robert Hall, but I am a licensed federal enrolled agent. No, I do not work for the IRS. I work against the IRS, and I assist and help my clients in filing business tax returns, individual tax returns, estates, trusts, nonprofits, you name it. If there's a form that needs to be filed with the federal government, our firm can help and assist in filing that. Today, I'm really excited to talk about what was signed into effect on July 4th. Specifically, I mean, there's a whole lot of topics that we can go over today, but specifically what has kind of gone into effect as of July 4th. Lots of changes on the horizon. And I do want to mention before we get into the meat and potatoes today, that whatever was signed into the bill on July 4th, things will be tweaked and amended and corrected between now and December 31st. However, a majority of what we talk about today is set in stone and will be impacting most real estate and most business returns across the US. It doesn't really matter what state you're in because this is a federal tax code change. And now we're waiting to see what states either conform to this new federal tax code, what states deny some of these changes. California tends to be an outlier where they really push against any federal tax code changes that are pro-business, pro-real estate. California decides what they want to allow investors to take as deductions, how they allow people to accelerate certain write-offs, so on and so forth. So we'll talk a little bit about that today, but we're still waiting to hear final verdict from a lot of these states on some of these really impactful changes on the horizon. Just a quick picture of our staff. I am by no means a one-man operation. I work alongside about 53 employees now, 54 employees here at Robert Hall & Associates. We need this kind of man and woman power to service the roughly 12,000 tax filings that we file across all 50 states. And yes, we do actually file tax returns in all 50 states with only one office location located in beautiful Southern California in Glendale, just a beautiful area to operate out of. I will remind you about this at the tail end when we do some Q&A, and I think Vince is going to have some Q&A throughout the webinar just from some clarifying points. But I'll show you this at the end. We do offer free consultations either in person or over the phone, via Zoom, FaceTime, however you want to connect with us. But I'll give you our contact information at the tail end today. My attorneys always want me to mention that everything that I speak on today is solely from a tax advisory perspective. I by no means am trying to offer legal advice in anything that we discuss today. So please do not take any of the information as legal advice. Always make sure to double check with your legal advisors before moving forward with anything that might have any type of legal ramifications. I am the income tax professional here. So let me switch to the next slide. All right, getting right into it. So back in 2017, the Trump's first administration passed something called the TCJA, Tax Cuts Act, and he very much wanted to extend a majority of what he had passed back in 2017, but in true fashion, like any governing agency, whether it be Republican or Democrat or liberal, when he wrote this bill, not when he wrote the bill, but when he signed the bill in 2017, that tax code in particular entering into 2018, which was then the Reform Act of 2018, it changed that tax code probably 25 to 30 times before year end. Some things were retroactive to the previous year. Most things started as of January 1st, but it was a very busy time in the tax world for us accountants. I foresee that the end of this year and the beginning of 2026 will be very reminiscent of the 2017-2018 transition and the new tax code coming out of Obama's administration into Trump's first administration. So we're going to see a lot of the extensions of that 2017 Tax Cuts Act with some tweaks and bringing back some major benefits, specifically on the business side, small business side, as well as the real estate investment forms that we file on an annual basis. These benefits, what I mean by extending them, they are no longer set to expire at the end of 2025. That's what the 2017 tax code was meant to do. It was meant to go out through 2025, then expire. He has repealed that, and now he is extending a lot of these tax cuts. Some of them indefinitely, some of them he's even used the word permanent, and then some are exhausting out until 2028 or in the year 2028, which we'll go over as well. One thing that I and probably Vince are very much excited about are the increase to the child tax credits. Whether we qualify for these credits or not is a different story, but I have been looking forward to hearing more about this. Personally, I was hoping that the child tax credit would have bumped well above $3,000 rather than only increasing by $200. But that's all we're getting as far as the child tax credit is concerned, as a bump from $2,000 per child up to $2,200 per child. And not everybody qualifies for the child tax credit. You have to make under a certain income threshold in order to qualify. And I haven't updated myself on those thresholds because they are going to change prior to year end. I'm almost positive that they're going to increase the threshold so more people qualify. So we're waiting to hear final verdict on those thresholds. These numbers are in fact indexed to inflation moving forward, which I believe that it has been this way under Trump's first administration, but when Biden took over under the Inflation Reduction Act, there was a specific part of the code that created the child tax credit not to index with inflation, so it stayed pretty status quo at about $2,000. Outside of the pandemic years where they bumped up to above $3,000 just during the pandemic years, and then they dropped back down to $2,000 once the government had felt like we were safe and free from the restraints of the pandemic years. Number three, one thing that we are all excited about and that we should be excited about is the bump in the SALT limitation. I don't know if you all recall, but back in 2018, under the tax reform bill, the Trump administration first term actually capped the amount of state and local taxes that individual taxpayers were able to deduct as far as what they could write off for their primary residence property taxes, their state and local taxes like use and sales tax, even property taxes on a second personal residence, not a rental property. We'll get to that in a second. But if you have two homes, both for personal use, you were able to deduct property taxes in prior years up to a certain amount. And then come 2017, 2018, they capped it at $10,000. That also includes, outside of property taxes, use and sales tax, that includes the amount of state income tax that you pay to the state of California. Let me give you an example of how this works. Let's say you're making, I don't know, $150,000 a year, and this is not the new tax bill, this is under the old tax bill. Let's say you're making $150,000 a year, which probably triggers a state liability of, I'd say, around 13 to 14 grand in tax. And then let's say you're paying $10,000 in property taxes on a primary residence. So you're at about 24 grand, and I'm being very, very simple with my calculations here, about 24 grand in state and local taxes. Well, prior to 2018, when you put the $24,000 deduction on your return, at 150 grand, you were allowed the full $24,000 deduction, because at that level of income prior to 2018, you were not subject to something called alternative minimum tax. AMT under the previous code, so prior to 2018, would only set in on your return once your household income exceeded roughly $375,000 to $400,000 of income. So anybody making under $375,000 to $400,000 wasn't subject to this AMT, and they were allowed their full state and local tax deduction. Well, fast forward to 2018, the federal government put a cap on the state and local taxes at $10,000, which got rid of a lot of deductions. But during that same moment in time, they introduced something called QBI, qualified business income deductions. And so that did a little bit of an offset and a little bit of a favor to the US taxpayer, but too many people got hit hard, especially California taxpayers and New York taxpayers, because we live in a high tax state. We pay high state income tax, we pay high property taxes. So a majority of California taxpayers were exceeding this $10,000 limitation. So that's kind of a little history of how that works. Now, AMT prior to 2018, it wasn't like you were able to deduct just anything in state and local taxes. Once you exceeded $375,000 to $400,000, you in fact weren't allowed any of your state and local taxes, not even $10,000. If alternative minimum tax started to set on your return, because it was like a sponge. It worked like a sponge. It would just suck up all of the property taxes, state income tax, local tax that you were paying throughout the year. So AMT was a terrible thing. And that started at about $375,000 to $400,000. Well, in 2018, Trump's administration capped state and local taxes at $10K, but then they increased the AMT threshold to, I think it was $800,000 plus dollars, which means that certain brackets that weren't allowed the deduction in prior years, even though they weren't able to deduct everything, they were at least allowed a $10,000 write-off. So there was a group of US taxpayers in California and New York that actually were gaining $10,000 write-offs under that particular code change. The reason why I'm mapping this out, and you should feel confused, by the way, I'm not saying that everybody should understand every word that's coming out of my mouth through this digital platform, but the reason why I'm telling you all of this is to show you how complicated the tax code is, and how it can become even more complicated when we have a change in power in the White House. And so utilizing a tax service like Robert Hall & Associates, or whoever you decide to choose for tax preparation services and advising, they need to understand a lot of these limitations and how to navigate around them, because there are some ways to eliminate some of these caps, especially if you are self-employed, where you prepay your state income tax at the corporate level and allow PTE, a pass-through entity election, to be made to where your corporation is actually paying all of your state income tax, and that is not subject or limited to that $10,000 state and local tax cap. It doesn't make sense in all brackets, but these are things that you need to have conversations with your accountants about. Fast forward to this new bill that was put in play or signed into effect on July 4th this year. The federal government has raised that $10,000 cap to $40,000. So a lot of us here in California, as long as our adjusted gross income is below $500,000, will be gaining up to a $30,000 bump in our state and local tax deduction. So what does this mean for all of us that are planners and like to plan ahead? We all need to make sure that prior to year end, we put a plan in place to help us get below, if we're exceeding a $500,000 threshold of AGI, adjusted gross income, we need to figure out every way possible to reduce our income to get us below 500 grand to gain that additional $30,000 state and local tax deduction. It's incredibly important for you to put aside some time prior to year end to plan for this particular change. Now, once again, some things are set to revert back, phase in, phase out. So this is set to revert back to $10,000 after 5 years. What I think the catalyst will be to continue on after this 5 years to keep it at 40 grand or even higher is the replacement of Trump's administration with another Republican president. If they replace the president with a Democratic president, they might repeal a lot of these things. Who knows? Once again, we're not talking about politics today. It's just this was a Republican change, whereas the Democrats had 4 years to alter the state and local tax deduction and focus on more, flushing cash back into the US economy through tax code change, and they opted not to do that. Biden had talked very briefly about bumping the $10,000 cap up to $80,000, which I thought, well, shoot, that is a fantastic change. I hope it goes through. And sure enough, nothing ever came to fruition on that end. Trump's administration is bumping it to 40 grand, which is great, but there are income limits, and this is in fact set to revert back to 10K after 5 years. So keep all of that in mind.
And Tony, just to jump in really quick, just to kind of summarize really quick for those folks that are, trying to piece that together. So those that are paying, that own a primary, that are paying California property taxes, and those that, of course, work here in California and have to pay California income tax, those two brackets, in addition to others, but those two main brackets are going to be eligible to leverage this SALT deduction, correct? Those are two big components of that.
That is correct. So I have some individuals who exceed that $10,000, even though they don't own a home and have no property taxes, just in their state income tax payment through their W-2s. So it's not only the property owners that can take advantage of this, it's also the individuals who don't own properties yet, but have high W-2 income that is subject to a certain amount of state income tax. So you're going to see a variation of different tax filer that qualifies and doesn't qualify. But I want to make sure that we kind of coming back towards the conversation of year-end planning, you need to set aside some time prior to December 31st to figure out how this impacts you personally. Just because your neighbor, your coworker, your friend, your family member, just because of Vince and me sitting here on the digital platform telling you what's possible, everybody's scenario is different. So set aside some time to talk with your tax advisor, make sure that you're maximizing that position as much as possible and qualifying for the full $40,000 deduction and avoiding that cap at $10,000 once you exceed 500 grand in adjusted gross income. Okay. Number 4, no federal income tax on tips and overtime. Now, I thought for sure that this was going to be a no limit benefit, meaning that didn't matter how much money you made, didn't matter how much overtime you got paid for. Like, I thought it was going to be a no limit soldier, essentially, where it was just everybody didn't have to pay tax on tips and overtime. Unfortunately, that was a pipe dream for me personally. At this point in time with this new bill, and this could be tweaked before year end as well, at this moment in time, you are able to deduct up to $25,000 of tips for workers earning under $150,000. So the people who this is going to impact the most are the baristas at Starbucks that serve you coffee when you go in to pick up your morning cup of coffee, the cocktail waitresses at local bars and restaurants, the bartenders who have lots of tips included in their wages. All of a sudden, if these bartenders and these waiters and the baristas, if they're making under 150 grand, they are able to back out up to $25,000 of their tips and pay nothing in tax on those tips. This is a major, major benefit for all of the lower kind of income individuals who are trying to just scrape up cash to potentially buy properties or to pay down student loan debt. Or to pay off credit card debt. I mean, that's a big thing in today's world now, especially with younger generations. They feel like home purchasing is not a possibility for them because of the student loan debts, because of the credit card debts, because of not having family members able to help and assist with down payments on these equity type growth investments. So this is, I'm just super excited to see how this maps out over the next couple of years. And then when you talk about overtime, so overtime is a little different. Tips are different because they specifically are tied to a job where you get paid tips, right? Whereas overtime could be a number of other industries or could kind of bring in a couple other industries. I'll give you an example. I have a couple clients who are what are called longshoremen, and they are individuals that work offshore, either on oil rigs or on tankers, and sometimes they'll be out in the open waters for months on end. And it tends to be the case where it could be up to 80% of their W-2 that is actually overtime. And so you got to be careful with this because we thought for sure that there was going to be a no limit. And we thought, oh my gosh, 80% W-2s that are all overtime. This includes firefighters. Sometimes law enforcement individuals get overtime, and that's where they get bumps in pay and everything. This would have been a major flush of excess cash back into the U.S. economy so that we could avoid printing more cash, which devalues the U.S. dollar in the long run. But the overtime deduction is going to be capped at $12,500 for a single individual, $25,000 for married filing joint individuals. So we're going to see how this maps out. It's not a huge cap. It's not a huge limit. It's not a huge benefit. But I do believe for the individuals who have lower overtime payments, that will be a pretty nice benefit, especially in a married filing joint status where 25 grand of your overtime just all of a sudden doesn't get taxed, which is a pretty big benefit. I mean, if you're in the, let's say the 22% bracket, $25,000 at 22% could save you an additional close to $6 grand in federal income tax. So it could make all the difference in the world to some of these individuals who are going to qualify for some of these benefits. Really, really great overall benefit, I think, that's coming out of that end of the tax code. Now, on the much opposite end of the spectrum, for those of you who are entering into retirement or who have already started collecting Social Security income, we thought that there was going to be no federal income tax on Social Security, and I was all excited about this as well, but I had to kind of peel back the layers of the onion and think about, okay, truly how the US government works when they change tax code, what kind of major benefits they offer. And I truly believe it was a pipe dream once again to think that no Social Security would be taxable at any income level. But at the end of the day, the federal government decided to limit the amount of Social Security that was going to be taxable for single individuals, seniors mainly, that make under 75,000 and a married filing joint couple under 150 grand. They get what's called a temporary additional deduction, which is added on to their standard deduction of $6,000. So in theory, if your standard deduction is 30 grand, you get to add 6 grand onto that standard deduction. Now you have $36,000 of income that does not have to pay tax. And the craziest thing about this, and a lot of people don't realize this, but that means that across the US in all 50 states, 88% of beneficiaries who are collecting Social Security will be lifted out of a taxable range, which means that basically 88% of US taxpayers who are collecting Social Security at the moment, the federal government estimates that they will no longer have a tax filing requirement. Now, for those of you who are trying to wrap your mind around this, you're thinking that's not possible, 88%. Well, just think about this. Remove California and New York for a second from the equation, and even Hawaii. Let's remove Hawaii as well. 47 states across the US. It is very possible for you to live in retirement solely on Social Security income in most of those 47 states. And here's how that works. If Social Security income is your only source of income, then the tax rate on all of those benefits is already 0%. So if my wife and I have maxed out Social Security, we get to the full ripe age of maxing out our Social Security benefits. Let's say we're both collecting $46,000 each. That's the highest I've seen on a 1099 SSA. I don't know if it can go any further than that, but I've seen 46 grand on 1099 SSAs before. So let's say that it's $92,000 between a married filing joint couple. If that is your only source of income, just the 92 grand of Social Security income, your tax rate is 0, both on the federal side and the state side. So in Birmingham, Alabama, making $92,000 a year, not paying any tax, not having a filing requirement, not having to pay financial advisors to manage or file tax returns for you, these are huge benefits. And you could very much live a great life in other parts of the US. Not so much here in California and New York. It would be probably difficult to live solely on Social Security income unless you had paid off properties, your property tax base was as low as what it was in 1950, 1960. Is it possible? Yes. But with eggs being, what, $20 a rack now, with milk being $10 a gallon, whatever you're paying these days, it's insane. Cost of living continues to increase. So for a lot of Californians, even with this benefit, it is still difficult to put away money for savings unless you're spending all of your benefits that are non-taxable throughout the calendar year. But this, in fact, is a calculation the government has come up with where they think. They think. It's not an assumption. They just think. And I don't know how they calculated this, but it will bring 88% of Social Security beneficiaries out of a taxable range. Yet to see what the overall result of this is. I'm excited to see the result no matter what. Number 6, the new deduction of auto loan interest. Now, much like most things, and we're going to get to bonus depreciation in the upcoming slides here, but much like most things that Trump has kind of wrapped his tax reform bill around, is US assembled and manufactured products and vehicles, right? So in order to get this deduction, it has to be an interest payment on a US assembled vehicle. It can't be a Porsche, it can't be a BMW, it can't be a Mercedes, right? However, and a lot of people are thinking, oh man, that's a bummer, it only applies to US manufactured vehicles. But I'll tell you right now that back in 2017, during Trump's first administration, when he introduced the bonus depreciation benefit, he also put in the tax code that in order to get that benefit, it has to be a US assembled vehicle. Well, Porsche and BMW and Mercedes, the way they got around this limitation is they would produce 95%, or they would assemble 95% of the vehicle abroad. They would ship the vehicle here to the US, and on US soil, they would install the GPS software system in the car. They would put on the rims and the tires here in the US. So at that point, they were able to stamp the final destination of assembly as US soil. And so they were able to navigate around this limitation. So I very much see that happening again for the interest deduction, still pending some changes to new legislation. We're going to see if there's any fine tune or fine print in the tax code before year end that changes any of that. But I do foresee that there's going to be a workaround on some of this stuff. Now, not everybody will qualify for this deduction. You will start to phase in or phase out of this deduction at 100 grand. And if you exceed 200 grand, you're going to fully phase out from being allowed this deduction. Now, this is for individuals who don't have businesses. When you own a corporation, when you own an LLC, when you have a vehicle that is written off through your business, guess what? The interest on your vehicle loan is tax deductible for your business because it's a business asset. So this really only applies to individuals who are not self-employed. They will be gaining this write-off as long as their income is below 100 grand, and they will slowly start to phase out from being allowed the benefit once they exceed 200 grand in total income. So just be aware of this, still fine-tuning the fine print of this particular part of the new tax bill. So keep all of that in mind. Business expensing. So one thing that I do, and I think that Vince is going to chime in here in a bit on this particular benefit here, is the ability to deduct 100% of an asset's depreciation all in 1 year. Now, this does not only apply to vehicle purchases, this also applies to rental investment or capital assets like commercial property investments or residential. It applies to both. Now, in 2024, the bonus depreciation was phasing out. We were only allowed 60% of a depreciation deduction in 2024. It was set to be only 40% for this year. But Trump's administration on July 4th signed into effect that they were bringing back 100% bonus depreciation. And if you notice the last word in this sentence that says permanent, I don't know how he's going to do it, but in this tax bill, he has made this change permanent, which means that in my mind, it means that any future presidents cannot repeal this part of the tax code, which I find to be very, very difficult to believe, almost impossible to believe this, because I feel like as a president, you can make most decisions and repeal certain changes. So he, in his tax bill, though, he was very adamant about putting the word permanent in here, which is hopeful for all of us as real estate investors, as business owners, that this will not be repealed. Heaven forbid somebody else takes office that doesn't believe in the same type of tax reform that the Trump administration has recently passed. So on the car purchase side, remember that the same bonus depreciation rules apply. The vehicle has to be over 6,000 pounds in order for it to qualify for 100% deductibility. If it weighs under 6,000 pounds gross weight, then you are limited on the first year bonus depreciation. I believe it's going to be around $22,000 to $23,000 in the first year. And then if the vehicle, once again, weighs under 6,000 pounds, you don't lose the rest of the write-off. You just have to deduct it and depreciate it over 5 years, which is the lifespan of a vehicle asset. If the vehicle weighs over 6,000 pounds, and this is gross weight, not curb weight. So you got to look up online what the gross weight of a vehicle is. Normally they give you the curb weight. The curb weight doesn't matter. It's usually about 1,000 to 1,500 pounds less than the gross weight. You got to look for gross weight of the vehicle. As long as that number is over 6,000 pounds, yes, it could qualify for the bonus depreciation. But also remember that the vehicle has to be assembled here in the US. I mentioned a couple minutes ago that the way that these foreign automotive companies, they get around this limitation is by, once again, assembling 95% abroad, shipping it here, assembling the remaining 5% here on US soil. Boom, therefore the final destination of assembly is stamped on US soil, and it does qualify at the end of the day for the 100% bonus depreciation. Now that's on the vehicle side. On the real estate side, this is where I'm just absolutely ecstatic for a number of reasons, because a lot of my clients who happen to be a majority of real estate investors, this also brings back the full benefit of a cost segregation election. Cost segregation is the ability to tell the government and make an election with the IRS to take anything that's part of the building of your rental property, right? Let's say we walk out of the house today, we find a rental property, we buy it for 700 grand today, right? And the asset has to be purchased after January of this year to qualify. It can't be, this is not for 2024, this is starting again in 2025. We go and we buy the $700,000 property. Let's say that $200,000 of that $700,000 is land value and $500,000 is building. We then take a look at this rental property. We figure, oh my gosh, there's a lot of depreciation we can squeeze out of this property through a cost seg election. So we send the property address and the value and the improvement costs over to our cost seg guy, Jeffrey Gann at GTG Consulting. He runs the numbers and figures that on this $500,000 building asset, we might be able to, let's say, accelerate $300,000 of the $500,000 building as bonus depreciation in the first year. Now, this all sounds great, right? This all sounds too good to be true. And for some people, it might be too good to be true because there are some limits based on industry, based on professional license, where not all of us will be able to take the full 300 grand. I'll give you another example. Let's say that 300 grand is the cost seg benefit. And let's say that me, Tony Watson, as a tax professional, not a real estate professional, I invest in real estate, but by no means am I a real estate professional. I make more than 51% of my income at my firm doing taxes. 51% or more of my time is spent here preparing taxes and consulting with clients. So I can't make the real estate professional election for myself. So if I make over $150,000, I'm not a real estate professional, and I elect cost segregation, I am only allowed enough of the depreciation deduction to offset the rental income I'm receiving. Meaning that if I collect 50 grand of rental income, I'm allowed $50,000 of the deduction. Everything that is in excess and kicks me into a loss, I don't lose the loss, I just don't use it in the current year. So in this scenario, let's say I have $300,000 in accelerated depreciation. I've got $50,000 in rental income. So now I offset the 50 grand of rental income and I have $250,000 left over. Once again, I don't lose it, I just don't use it. I carry that forward as what's called an unallowed passive loss carry forward. That's the term in the tax world. And that 250 grand will carry forward and offset future income on any real estate related or passive real estate investment income that I receive moving forward. So once again, I don't lose it, I just don't use it. If I am a real estate professional though, I spend over 750 hours working in the real estate in a real estate related activity, whether it be managing my own properties or selling real estate for commission income. I'm a licensed realtor at that point. I make all of the appropriate elections to be a real estate professional. There are no limits to what losses you can deduct as a real estate professional, meaning that you can make $700,000, $800,000, $900,000 to $1 million of income well above the $150,000 loss threshold, where people start to phase out from being allowed the loss anyway at 150 grand. As a real estate professional, I could make $1 million and I can cost seg all of my real estate investments and dollar for dollar offset all of my income with 100% bonus depreciation. Now, this does not work that well with properties that you've owned for 3, 4, 5+ years. This specifically works best with newly acquired properties or properties that are at most 2 years old. So I'm not saying that you can't cost seg an old property, but it just doesn't work the same. There are limits to what you can accelerate on older properties. So we're sitting here August 26th in 2025. Let's say that you on today's webinar, you purchased a property in 2024. It's not too late. You can actually do a cost seg election in 2025 for the 2024 tax year, but you're only going to get 60% because remember that was the limit in 2024. If you bought a property this year after January of 2025, so anytime this year, if you sit down and do a cost seg election in 2025, you will qualify for whatever that number ends up being. In our example, it was 300 grand. You could be unleashing a massive upfront dollar for dollar deduction, which guess what? Not only is acceptable at the federal level, but is also acceptable at the state level. The state actually conforms to this part of the tax code. It's called Section 481A of the Internal Revenue Code. And that just happens to be a massive windfall benefit. So kind of going back a couple slides when we were looking at that $500,000 threshold where you started to phase out from being allowed that $40,000 SALT limitation, you had to cap yourself at 10 grand. This is an incredibly unique opportunity to elect something in 2025 that may drop you from $700,000, $800,000 below 500 grand, offsetting a ton of taxable income, and then also putting you into a bracket where you're qualifying for the $40,000 state and local tax deduction versus being capped and limited to $10,000. Kind of wrapping this into another conversation, the thing that I said earlier, this all comes down to proper planning. You do not want to enter into this election if you don't know what you're doing, number one. Number two, without the appropriate advice on this. This will help businesses write off equipment dollar for dollar, machinery costs upfront, as well as able to accelerate a portion of your building assets dollar for dollar all in the first year. Vince, do you have anything to add on this slide?
Well, you covered that so well, and all I can say is, experiencing this personally, and fortunately, my designation of being a real estate professional, this was something that you helped me implement personally, and it was just an absolute game changer in strategy, right? And I think all I can say is, as it pertains to kind of us working together from a real estate side and a tax side, this particular topic is so crucial to that kind of working symbiotic relationship. So many people oftentimes reach out to us at Marshall Reddick, and they understand that real estate is a good avenue for tax savings and tax deductions, and I think now that speaks more than ever. One just quick question or clarity, if it's not too complicated, was just about those folks that are not real estate professionals, and if they're as it pertains to like cost segregation and taking advantage of that bonus depreciation, is it exclusively held to rental property income, or can it offset things that are outside of rental property income?
That's great question. That's the craziest thing about all of this, is that when you are able to unleash the real estate professional status side of things and allow that massive deduction to flow through, not only offsetting the rental income collected, but then exceed the bottom line net zero and push you into a loss, some individuals, pending proper planning, may be able to take, in this scenario, let's say the $250,000 loss that we were using in the example, that 250 grand could potentially flow through and offset W-2 income. It absolutely can offset retirement pension distributions or 401k distributions. It's a unique opportunity in certain instances to get your income bracket so low that in that year you do Roth conversions from tax deferred retirement accounts into tax-free growth retirement accounts. It is one of the unicorns of the tax industry. I can tell you that right now. I don't know how else to describe it, but there aren't too many people who are able to take advantage of this. And when they are able to take advantage of it, it opens up just so many other parts of the planning scenarios on the tax side. I've used this in most scenarios, most cases where people have been able to convert $200,000-$300,000 of 401k deferred income into Roth 401k or Roth IRA accounts, allowing the cost seg to offset the tax implication on the conversion. I've had married couples where one individual is actively working, one headed into full-blown retirement. So we flip the retired individual over to a real estate professional because they're no longer actively participating in any other work. Now that one individual in the relationship is a real estate professional, any cost seg elections on the real estate are allowed as a direct offset to the other spouse that is still working and their W-2 income. I mean, you can mix and match this in so many different ways, but you need the guidance and the advice of a licensed tax advisor to know what is possible and what is not. I'm not saying not possible, but what is truly pushing the envelope too far. I've seen a lot of returns where people it's like the Wild West. They check these boxes to see how they get the refund higher. That's not the approach that you want to take here. There is very much a due diligence side of making these elections, making these cost seg deductions work to your benefit. And it all has to be a plan prior to year end. Even though the cost seg doesn't have to be elected before year end, you can do the cost seg next year for 2025, but you got to have a plan in place just to make sure that you're going to be able to capitalize on that position, if that makes sense. Does that make sense, Vince? Any other comments on that?
No, that's amazing. That is amazing. And thank you for elaborating on that.
Of course. All right, so I'm sure that there's a ton of questions around that. That once again, we offer free consultations if you want to dive more into detail. We can always hop on the phone with someone here at the firm and map that out. One other major change is that starting in 2025, or I'm sorry, it might be 2026. I have to double check on this. But in 2024, you were allowed up to a $300 miscellaneous cash contribution per taxpayer. So a married filing joint couple was just allowed a $600 charitable contribution. It's called miscellaneous cash out of pocket. If you're a single individual, you were allowed $300. They are increasing that to $1,000 for a single individual, $2,000 for a married filing joint couple. And in order to get this benefit, you do not need to itemize to claim this deduction. It ends up being an adjustment to your income. So whether you itemize your deductions or not, the federal government is giving you an allowable $1,000 to single individuals as charitable deductions, $2,000 for married filing joint individuals. A really great benefit. I didn't want to spend too much time on that because it's not really, doesn't really impact a whole lot of people. It'll just be an added benefit to our tax filings each year moving forward. One thing that I'm still waiting to hear more detail on, this is, once again, some of these things seem too good to be true, but starting with children who are born in 2025, the Trump administration is introducing something called Trump accounts, which are very similar to Roth IRAs. And once again, politics aside, I feel like this is an incredibly narcissistic thing to do and call it Trump accounts. They should have just called it, government Roth IRA accounts. But you gotta love the theater in today's world. But they are called Trump accounts. That's the noted term for these accounts. And what the government's going to be doing is seeding $1,000 into tax-free growth accounts for children born between years 2025 and 2028, with possibly extending it past 2028. And these accounts work very much like retirement accounts, where they grow tax-free as Roth. Tax deferred growth. So it's tax deferred growth like a retirement account, not Roth. It's very much like just giving or contributing money to people who need retirement accounts, who don't have deferred retirement accounts. Still waiting to hear if there is going to be a Roth module. That's why I got a little confused in my verbiage there. We're still waiting to hear if certain income brackets, because what I read the other day is that they're thinking if you're below a certain income bracket, that this particular Trump account will be set up more like a Roth account and not a deferred account. Once again, still waiting to hear on the fine-tuned verbiage on this particular part of the code. Nothing you really need to do, though. Once you have a child in 2025, 26, 27, 28, these accounts will be set up. $1,000 will be seeded into the account, and they will grow tax deferred until that individual is old enough to contribute on their own. Once again, pending however this is going to map out. Sounds too good to be true, but this is very much built into this 2025 tax code, which is wild. It's absolutely wild in my opinion, but we're waiting to hear more detail on that. Last but not least, EV and clean energy credit phase outs. EV vehicle credits are set to end not at the tail end of this year, but in September of this year. So literally at the end of this next month, which is wild to think about. That means that if you were thinking about buying an electric vehicle to take advantage of the EV credit and you buy it after September, you're not going to qualify for the electric vehicle credit. You'll still qualify for bonus depreciation if the vehicle weighs over 6,000 pounds. If it's under 6,000 pounds, it'll be limited, but you'll still qualify for that if you buy it under a business. But the $7,500 EV vehicle credit, or even the limited credit for a used vehicle, those are going away. What I think will happen, though, is when you go to these dealerships to buy a vehicle, the dealerships are going to offer the credit to apply against purchase price, like they've been doing in past years. So instead of waiting to get the credit on a tax filing, you can elect to apply that $7,500 credit to reduce the purchase price, getting pretty much the same benefit at the end of the day. I've had a lot of clients do that and exercise that already. Even though the credits are still available, it made more sense because of their income threshold being above 300 grand. They weren't going to be allowed the credit on the tax return. So the dealership allowed the credit to offset purchase price. Pretty cool benefit on the dealership side. The solar and wind credit phase outs won't start to phase out until mid 2026, which means that you'll still be able to take advantage of the solar credits through the mid 2026. So if you need to get that solar system on your house, if you need to do drywall, insulation, window repair, doors, HVAC upgrades, water heaters, I suggest you do it before year end, because I do believe that there will once again be fine-tuned verbiage that states that the contract had to be signed prior to year end, or the work had to be started for install prior to year end. Still waiting on a lot of the fine font in the verbiage in this part of the tax code. But be aware that these parts of the code, these 10 things, will change and be altered prior to December 31st. So towards the end of the year, we're going to be ramping up again with new seminars, new webinars, and bringing you the most up-to-date information possible. And just an added slide here, something that coming from a household of 2 teachers, both my parents were educators. They were both business owners. My father owned part of the Kentucky Fried Chicken franchise. His entire life owned a burger joint as well, owned the real estate that the restaurants operated out of. My mother was a real estate agent at one point, but then they ended up going into education. And up until 2018, educators specifically were able to deduct their unreimbursed business expenses. And then 2018's bill passed, and it removed teacher, firefighter, police officer, any W-2 wage earners or public servants here in the US. It removed a form from the tax return in 2018 that allowed them to write these expenses off, assuming that the districts and the law enforcement departments and the firefighting departments, assuming that they would inherit those costs on behalf of their employees. Well, that's not what happened. And so teachers still continue to come out of pocket $10,000, $15,000, $20,000 a year. I have a teacher, no joke. I have one teacher in San Marino Valley that spends over $35,000 a year on classroom supplies, field trip things, classroom rewards and prizes. I mean, she is just such a beautiful person, beautiful soul. I really wish I could go back and be in kindergarten and those younger ages classrooms again, because she's just incredible at what she does, and she pays out of her own pocket. And starting in 2018, she wasn't allowed a lot of those write-offs anymore. So under this new tax bill, they are bringing back an allowable deduction for teachers and educators specifically. This is now being expanded to include coaches, PE instructors, and also non-athletic health education professionals with their supplies, their classroom supplies, their field trip expenses, so on and so forth. So I'm really looking forward to how this all maps out. In the prior code, they were allowing a $300 cap, basically a classroom credit of $300. Well, I mean, these teachers spend way over $300. It's insane. I don't even know how they calculated this $300, but it is set to expand under this new structure, which I'm hoping they bring all of those deductions back. Really looking forward to guidance on that. But once again, guidance is still pending to clarify how the expanded deduction will be applied. Still waiting to hear on the final verdict on that end. This will not be effective for 2025, unfortunately. This will start January 1st of 2026. I got my hopes up thinking that would be starting this year, but in fact, it is going to be starting January 1st of 2026. Waiting to see if that is going to be retroactive though for 2025. I think that there's a good chance that the current administration will make it retroactive for 2025, pending year-end changes. All right, Vince, that was all I got for today, man. Once again, we offer free consultations. If you want to take a quick picture of the QR code, sign up for a free consultation with my office. You could shoot me an email at TonyWatson@RobertHall Taxes if you want to onboard for a free consultation. That's the best way to connect with my office. And Vince, if we want to open up for Q&A, I am ready to rock and roll.
Yeah, that was amazing, Tony. Thank you so much. And we really appreciate all the time spent and all of the information. It is incredibly helpful to go over that. Yeah, I had just 1 or 2 questions that came in, and let me get to those really quick, if you don't mind. One of them was in regards to the overtime. Does the overtime deduction apply to salaried workers? Was that something that you'd be able to cover?
Well, yeah, I mean, overtime would really only apply to W-2 wage. Well, okay, so salary does apply. It's just, with salary wage earners, technically the overtime is calculated differently. So depending on the income threshold, I think that most salary wage earners and I think it mainly specifically deals with W-2 wage earners, not whether you're salaried or part-time. This will be any individual who makes under a certain income threshold and has overtime and tips allocated on their wages. So no, it doesn't matter if you're salaried. We have some salary individuals here at the office that during tax season get paid overtime. They don't make nearly the income threshold that they would phase out at. So they will enjoy and reap a nice tax benefit on their W-2s come tax time. So no, I think that answers the question. If not, if you can clarify and I can answer it in a little bit more detail.
Yeah, no, that was perfect. That was perfect. One other quick question is, I know a lot of folks that, have these long-standing relationships. I run into clients like this all the time. They have long-standing relationships with their existing tax professionals, and sometimes just feel as though maybe that specific individual is not taking advantage of the code or not as familiar with real estate or other components. Do you guys offer the ability to review a previously filed tax return or be able to kind of take a look to see what's being missed to determine if it's worth, coming aboard to Robert Hall and Associates?
Sure, that's probably one of the most beneficial parts of our free consultations is that our office, when we onboard you and we set you on the calendar, our team asks for the most recent filed return or the most recent 2 years of filed returns so that we, prior to us hopping on the phone or on Zoom, we can review those tax documents, see what was taken as a deduction, and see what we would change or advise moving forward. Giving us a blank canvas, just open for conversation and questions, is fine as well. But we do like to get comfortable with your tax situation, reviewing what's been filed in the past, what you've missed. And make no mistake, there have been times during these free consultations where we have looked at those prior filed returns, opened up those returns and amended those returns to add certain things that your previous preparer did not take advantage of. A lot of people fear amending returns, but if things were forgotten or missed or not taken advantage of, there should be no fear in going back and correcting a return. The only downside to amending a return is that you think, oh, well, I'm getting this money back now. Now, because of the IRS, basically the federal government letting go of 35,000 agents earlier this year, set to let go of another 20,000 agents prior to year end, that refund on the amended return could take up to 6 to 8 months to get. No harm, no foul, because it was money you didn't have yesterday, and it'll be money that you have in the next 6 to 8 months. But we will absolutely take the necessary steps to correct anything that was forgotten or mistakenly input on the prior year returns through that review.
Yeah, awesome. Thank you so much for that. That's so helpful, and I think that's such an amazing benefit to all of our potential clients that are interested in your services. I did get a question about the recording of this presentation. So I will be doing some follow-up calls this week. We will have this presentation recorded and we will have this sent out. I'm more than happy to make the connections to the team at Robert Hall or to facilitate that in any way possible. There's a few other questions, and what we'll do is I'll make sure to make those connections to get those specific get you specific answers to those questions. But again, Tony, I wanted to thank you so much for your time. Your knowledge is so invaluable, especially with the new changes, and we very much appreciate it. And again, thank you again.
Vince, always good sharing the digital podium with you, and I appreciate you including Robert Hall and Associates and myself in today's presentation. Thanks everyone for joining. Appreciate it.
Thank you.